Hello folks, this is Matthew Guerra with Learning the Mortgage Process. Today we're going to be talking about the conventional mortgage. Some people can purchase a house with a conventional mortgage, some may decide an FHA, an USDA, or a VA loan. But we're going to discuss the conventional mortgage. And for those of you who may not remember, this is Matthew Guerra with Seacoast Mortgage. Phone number is 401-640-3364. And my email is mguerra@seacoastmortgage.com. So today we're going to look specifically at the conventional mortgage. One reason people decide to go with the conventional mortgage is the mortgage insurance cancels itself when you have 20 to 22% equity. What that means is when you owe less than $160,000 in a house that you paid $200,000 for, the mortgage insurance will disappear, and your mortgage payment will actually be reduced by that amount. So people are happy to see that. People with higher credit scores are rewarded with lower interest rates on a conventional mortgage. A conventional mortgage can be used on investment property, but you do need 25% down on it. Cons is, for multifamilies, you need to have a more substantial down payment than 3 or 5%. With a 2-unit, you need to put 15% down. With a 3 or 4 family, you need to put 20% down. If you're owner-occupying, 25% down if it's investment property. The interest rates are higher on a conventional mortgage, and mortgage insurance rates can get pretty pricey if your credit score is in the lower 600s. Usually you have to put 5% down as opposed to an FHA, which is 3.5% down. But if you're a first-time home buyer, you could put 3% down on a conventional mortgage. However, that gets very pricey with the mortgage insurance. Also, Rhode Island Housing, if you happen to be in the state of Rhode Island, does offer a zero-down conventional product, which is pretty fascinating, actually. All right, so let's decide how to figure out how to calculate your mortgage payment. It's an important thing to do. But first, let's say, okay, I'm going to buy a house, and I'm going to buy this one. You search on any thing like Online Living or iConnect or MLS, and you just find, hey, I want to buy this house. This is a $149,000 house in Tiverton. How do you find out what that house is going to cost you? You could do some rough math. You can go to Google, you can type in mortgage calculator, and you can put in your mortgage amount, which is $149,000. Assuming you have excellent credit, you're looking at a 4.125 credit score today. And the mortgage period's 30 years, and your payment will be $722. But it doesn't usually work that easily. So let me show you how to use a spreadsheet to figure this out. So first is we're going to buy the house for $149,000. Let's say we give them the asking price. Down payment. We know that we generally have to put 5% down. So it's 0.05 in number terms. It's 5% of what? The purchase price. So multiply the purchase price right by it. There's your down payment, $7,450. The interest rate we said was going to be 4.125. So that's going to be 4.125, and actually, let us make the number look better. So now on the mortgage, there's an interest and a principal part. So let's deal with the very first payment. Excel has a lot of very nifty features and functions within the program that's worth using. The IPMT will return the interest portion of the payment of a mortgage payment. So your interest rate is going to be 4.125. However, you need to divide by 12. To make a long story short about why you have to divide by 12, we have to look at the fact that we're doing this over 12 years. That 4.125% interest is being charged over 12 years, and we're looking at 1 month of that. We're going to focus on the first period. There's 360 periods total. We're getting a 30-year mortgage. And the principal value is going to be the purchase price of the house minus, you've already put in, your down payment. So the interest portion of your mortgage is going to be $486. Now let's focus on the principal part. Exact same procedure. PPMT is the formula. And again, it's 4.125% divided by 12. Again, first payment out of 360. And we're going with the price of the house minus the down payment that we're putting in. So there's the principal part. Now, the mortgage insurance. You won't know this number off the top of your head. However, mortgage insurance is usually about about 0.7%. So I'll put 0.70 times the amount you owe on the house, which is going to be this, minus your down payment, and every month is what it gets charged, so it's 1/12 of the 7%. So you're looking at probably $82 a month on mortgage insurance. So now your entire mortgage payment, and we've got some negatives and some positives here, so let's try to keep them all in the same function. We're going to take our interest, we're going to take our principal, and because we have the mortgage insurance showing up as a positive number, let's just subtract out the mortgage insurance. So our payment is $68.59. But you're not done. You have to insure the house. Tiverton has rough wind, so the wind insurance alone will cause the price to go to about $110 per month. And we also need to figure out the real estate taxes. Well, the real estate taxes are not too hard. Let's go back to the house. Usually you'll find it somewhere hidden in the listing, the real estate taxes. On this property, I'm highlighting it, it's $39.22. So this equals $39.22. However, again, you pay for it every month. And let's make this money. So your payment is $326 each month. So for your mortgage, it's your mortgage payment minus you pay out real estate taxes, and you have to pay out your insurance. So to own that house, it will cost you $1,205.43 every single month, and that's assuming you put 5% down. So hopefully you can understand how you can figure out the mortgage payment on a conventional mortgage, and you can include in your real estate taxes and your insurance. If a house has a condo fee, which makes it a condo, not a house, you can also add that in the same way we did real estate taxes and insurance. Again, my name is Matthew Guerra with Seacoast Mortgage. Hopefully you found this video to be very interesting. Next, I'm going to be doing a video on an FHA loan, which includes mortgage insurance, but also an initial funding of mortgage insurance on purchase day. So there's an extra layer of math involved in an FHA loan. Also, look ahead for some other videos, especially looking at DTI, which is debt to income ratio, to see if you can qualify to purchase a house. Thank you very much for watching, and I will hopefully hear from you soon. Thanks. Bye-bye.